Joining us now is Eddie Ghabour, Key Advisors Managing Partner, joining us to talk about his market outlook. Hi, Eddie. Good to see you. Your thoughts after we saw several weeks of gains. The S&P, in fact, has had a great 4 weeks. 1 month, it's up almost 5.5%. Now what?
Look, I think this is nothing more than a bear market bounce. And in bear markets, you get these massive, violent bounces that happen really quick. And I think it's great because it gives investors a second chance to reassess risk and to consider potentially taking risk off the table. As I look at the setup for this next quarter, this quarter that we're in right now, I don't like the setup at all. I think we are turning this is going to be a bear trap that's going to bring investors in. And just as fast as it went up, in my opinion, it could be down. One thing I'm going to be watching very closely as earnings start to come out next week is the guidance they're going to give moving forward, because I think you're going to see a lot of revisions to the downside because of how slow the economy's growing. And the other thing, too, is the Fed hasn't raised rates quite a bit yet. They're talking about a 50 basis point hike next month. If they do that during this slowdown, I do not see how risk assets do not correct. So unfortunately, I'm about as cautious as you can be right now, even with this bounce, because again, I think we're basically in a bear market right now, and we're not going to get out of it, in my opinion, until the Fed pivots and goes back to loosening versus tightening.
Well, or how about loosening? Well, come on, Eddie, that's how about just stopping tightening?
Well, that'll be the first step, but the million-dollar question is how low does the S&P and the broader market have to go down before they pivot? The bottom line is they are so late to tightening that now they're forced to tighten at the worst possible time economically. And look, the consumer's getting hammered right now with inflation. I don't see how anyone thinks that the discretionary spending numbers are going to be anywhere near where they were this time last year. And that's why we're so cautious. There's just not a lot of positives right now. And the last thing I want to hit on, the one positive has been real estate. With the 30-year mortgages spiking the way they have here recent weeks, that could ultimately start to bring some cracks in the real estate market. And then we'll have a whole nother set of problems hitting us right now. So it's a strange time period. It's a lot of risk out there. I just think it's prudent to be cautious at this time.
Yeah, I saw mortgage rates zooming past 4.5%. You know, the tightening, this, raising rates hasn't happened for 4 years. So are you saying that you might have to wait 4 years to see the markets turn around and have a rally that you believe in? That doesn't sound right. Is that right?
I think the Fed is going to raise rates like they say, but I think the market is going to go down pretty fast because I think they're probably miscalculating how slow GDP actually is. And once they make that announcement that they potentially are pausing their tightening, more than likely it will be kind of in line when we've had a bottom in the market. So I think there's probably going to be some amazing buying opportunities later this year. I just personally would not be doing that in high-risk assets right now going into one of the toughest quarters for comps that we've seen in our lifetime.
So here's the thing, Jamie Dimon talking about everything that's going on in the confluence of factors. We're not worried about our direct exposure to Russia, though we could still lose about $1 billion over time. So tell me a little bit about that. And, it sounds like you agree with him to a certain extent. This, as rates are on the rise and profits are decelerating, we're going to start earnings season next week.
That's exactly right. I mean, the deceleration of GDP and earnings while the Fed is tightening, while we have geopolitical issues that have caused commodity prices like corn and other things like that to stay really high, is why when you look at all the macro dynamics that are facing us right now, there are a lot of headwinds. And I think for me to ignore that and not bring that to our clients' attention would be a big problem. So we have absolutely pivoted in our portfolios. We pretty much own the opposite of what we owned this time last year because we think the environment is the complete opposite. Last year, growth was accelerating. Inflation was under control. Now we have the complete opposite dynamic. And so I don't know how you can own the same thing when the environment is quite different.
Yeah, and you have, exactly, there's nothing to compare exactly what we're experiencing here at this time. Eddie Ghabour, nice to see you. Thank you always. Eddie Ghabour, Managing Partner at Key Advisors. Thank you.